All right, looks like we're live. Welcome everybody to Live Valuation. I'm Midas Moriarty, and today we're going to be taking a look at ticker EAF, GrafTech International. Pretty interesting company. I'm very excited to cover them. We have covered them once before on the channel, but we're doing a little bit of a different approach this time around in how we're thinking about the revenue. So I'm interested to share what I came up with that. GrafTech International, they produce graphite and other carbon-based electric arc furnace-based steel, hence the ticker EAF, electric arc furnace. Kind of interesting. I thought that was kind of neat. They snagged that ticker, which kind of cute little detail. But they have specialized steel products that they produce and manufacture for people. A decent amount of it on a pre-agreed long-term arrangement kind of contract basis, which is a little bit of an interesting detail about their business model that we'll get into. But they're pretty interesting business with a quality to their product that I think gives them a neat competitive advantage that we'll talk about. Kind of taking a look at the watch list today, kind of skipping past the actual watch list itself because Google's kind of being a little weird today. Doesn't seem to want to have sheets function very well. Hopefully I can at least get the GrafTech part of it, but I'm having difficulty kind of doing a lot of the Google Finance importing functions today, so kind of can skip past at least talk about where the things in the market specifically are and just kind of talk about where things are economically. Today we had the PPI index come out, producer price index, which was a follow-up to the CPI report that came out yesterday. Very large up spike in the CPI report, which I definitely had pretty solid expectations of, but a lot of other people were, I guess, surprised that it was continuing to move up, where a lot of people were starting to claim that deflation was on the horizon, and I didn't think that was likely based off of where retail sales had been moving, as well as where the PPI index had been previously, and that gets into where the PPI index was today, which was another upward movement. So in my opinion, that's a further starting indicator, a leading indicator towards future inflationary increases. The way I look at it is that a lot of people were pointing out the fact that the commodity prices had come down over the last month or two, and so they thought that meant the CPI would come down. But the commodities is where it starts. It's like the commodity prices is like the start base level, and then a month or two later it starts to hit the PPI index, which is where what the producers actually paid for the commodities at the end of the day when they needed it, for the actual demand. And so once that starts to move downward, then a few months later, after it makes it through all of the mid-level parts of the economy, the business-to-business aspects of it, it reaches the consumer inflationary numbers. So its commodity prices come down. A few months later, the PPI index comes down, and then perhaps then a few months later, the CPI comes down. Of course, that doesn't take into account the services part of the economy, but the services part of the economy is in many ways reliant on the underlying materials part. So the way I look at it is that we have to see the PPI index come down significantly before the PPI index, or the PPI index has to come down significantly before the CPI index is going to come down in any real meaningful way. So as far as I'm concerned, we still have ways to go. And with that, we do actually still get retail sales tomorrow, as well as the import and export prices, which I also look at as kind of like an unmitigated kind of inflationary gauge as far as like the prices that we are for the goods that we produce home and are selling off. Which is usually a little bit more expensive than the ones we purchase at home, because we like to have the better stuff for ourselves typically, but also gives us an idea of the prices of the rest of the world and how that relates to the 30 or whatever percent of the economy that of goods that we import and stuff. So very important information coming out in the next few days, as well as the business inventories come out, as well as the consumer sentiment. So basically on the 15th, we're getting a whole lot of important information. And then we're also going to be getting more information next week, and then the week after that we get our FOMC meeting. So lots of interesting economic data to be coming on the horizon. As far as our plans for the channel, after the stream today, we're doing, like I said, GrafTech today. I know I had talked about potentially doing Kroger as the next one. It looks like I'm probably going to be doing that, as well as I'm also considering taking a look at Virtue Financials, VIRT, which was a suggestion from a viewer on the channel. I've been preparing the valuations for both those, KR and Virtue Financial, and I'm trying to look for another one to kind of fill the gaps before Alibaba's 10K comes out, or Microsoft's 10K comes out, or one of the other ones that I've since said I'm going to be doing as well in the near future. So we will get into GrafTech more specifically. Before we actually get into some of the details in their financials, I will take a quick look at their PowerPoint presentation for the earnings deck from Q1, a little bit past the financials that we're looking at. Not super interested in the safety aspect, but nice to see they had a nice downward trend in their injuries, though it looks like they spiked up again in Q1, but whatever. Just kind of notes that they put in the general industry and the growth in the pricing. Continued strong demand for increased graphite electrode prices in Q1. The ongoing transition from a more traditional form of steel furnacing to electric arc furnacing, which is kind of again their forte. So that's part of their growth potential, is off of the back of a transition from an older form of steel production to this newer, more efficient form of steel production, as well as the fact that there has been a strong upward movement in the pricing for petroleum needle coke, which is related to the increase in pricing for other petroleum products and energy products in general, as well as steel prices being well above their norms, partially related because of those input pricing being above that. Because that's the thing about steel. It's like steel is not a direct commodity. It's a more of a mid-level commodity based off of iron and carbon and many other direct inputs that get produced into the steel. And hence that's why steel actually has many different quality levels depending on who's producing it and the process that they're using. So steel prices are not going to have the same sort of upward movement as other base commodities where our pricing models that we've used have applied. And in fact, I had difficulty getting a hold of daily steel information last time I was trying to do this valuation. So I didn't actually do a commodity pricing based off of steel. I actually did it based off of oil itself, since petroleum was a main input for them. So it was really more thinking about their inputs than about their actual revenues, the way I did it last time. And I knew that was kind of a subpar way of doing it, but again, I had difficulty getting the information I wanted. This time around, I do actually have daily pricing information for steel, so I can go ahead and use that. However, like I said, with the caveat that steel isn't going to behave the same as another base level commodity, because it's more of a mid-level commodity. It's not really a commodity at all. That's kind of the point I'm trying to make. But we'll get into that when let's take a look at the steel sheet here in a minute, or when we start to get into the revenues actually. Taking a look at their projections that they've made for the revenues of 2022 and beyond that gets into the way that they actually like to disaggregate the revenues, which is by the long-term agreements that they make with businesses to produce a certain amount on a certain basis versus the more of on-demand production for the steel that they produce. So the estimated LTAs represents the portion that's off under contract. So 860 to 960 million, therefore a midpoint of 910 million of LTA revenue. Again, we would have to kind of compare that to the revenues that they've had traditionally, which will kind of flip over to the 10K that I have up here as well. In the disaggregation of revenue, you can see graphite electrodes LTAs in 2021, they had about 1 billion or so. So the idea that they're already projecting that would drop down to about a midpoint of maybe 910 means that the long-term agreements have come down in 2022 versus 2021. However, they have had significant spike ups from 2020 to 2021 in the non-LTA sales for the graphite electrodes. And so they're also arguing that is probably going to be bit more sustained, especially with the higher prices for commodities around the board. Even though, yes, commodities have come down a little bit in the last few months, they're still generally at an elevated level. And they basically talk about that around here, at least in relation to the Ukraine-Russia impact. They've force majeure certain LTAs they had related to customers they had in Russia. However, they expect higher non-LTA sales to offset that. I expect higher non-LTA sales to offset the general decline in the LTAs that they have. Full stop. And then they also talk about the LTAs they have for 2023 2024, which is about half as much spread across 2 years. So really it's about a quarter of as much, but those long-term agreements will start to be put in place throughout the year moving forward. So basically that gives us an idea of where the 2022 revenues may be. This is just one chunk of the revenues, but comparing that again to that being majority of the revenues here was about 4/5 or so of their total revenues is what it looks like that kind of comes out to be. And so maybe the LTAs are a little bit less in terms of that, but then the non-LTAs kind of spike up against that. On net, perhaps it's still a smaller amount of revenue. Again, 1.3 billion was what they had here, so we can kind of take that into account when we get to projecting the revenues. I'm pretty sure, let's see, there wasn't too much more I wanted to look at in the earnings deck. I'm pretty sure that was basically all stuff that I wanted to look at there. We'll get into taking a look at the actual valuation, and we usually start at the bottom with the segmentation and how we like to think about that. The segment that I'm putting them in is electrical equipment, or 2/3 electrical equipment, 1/3 steel. It's kind of the way I'm thinking about it. That's because they basically do produce steel for electrical equipment, but it's an application form of steel. So that's just a specific judicious choice that I chose to make for this particular valuation. It gives me an unlevered beta of 1.03 and a sales capital expectation of 1.77 and an adjusted margin of 9.32. So with that, we can move on to the geographic disaggregation. They get about 50% of the revenues from EMEA, which is Europe, Middle East, and Africa, for people who aren't familiar with the acronym. About 21% from the United States, 17 to 18% from non-United States Americas, and then 11% or so from Asia Pacific. As far as the revenues go, that gets me the equity risk premium of 5.85, and then they have production, about 35% of it in the United States, 24 to 25% in Mexico, 18 to 19% in France, 20% in Spain, and less than 1% in Brazil, less than 1% everywhere else. So pretty interesting disaggregation of the production across different geographies as well. That gets us a 5.06 for another portion of the equity risk premium, which I'm weighting the production revenues equally. That's typically how I do it. That gets me to an updated ERP after adjusting for a more daily updated ratio to 7.45. So a pretty healthy equity risk premium. And after adjusting the unlevered beta for their debt to equity ratio, which is about 69%, that brings us to a levered beta of 1.66. Bringing the cost of equity to 15.35. So pretty strong cost of equity. And obviously you can see that I have them at least as fair value with a small amount of upside. So even with a pretty strong discounting effect, they're coming out to be at least a decent valuation, which we'll get into some of the specifics surrounding that. Taking a look at their debt, they have about $1 billion in debt, which is where we end up with that 69% debt to equity ratio, which includes lease liabilities, at a weighted average discount rate of about 4 years, and a weighted average interest rate of about 5.7. So a little bit higher interest rate than the kind of benchmark point where we start to think of it about high, but not terribly so. Not a ridiculously high interest rate. And the maturity is relatively short. That does mean that they would have to roll over their debt or actually pay it out during the projection period, which is a little bit of something that always you want to keep into account when you're thinking about where the valuation is going, like what the cash flow is going to have to be used for over the years. So we can start to take a look at the historic information that we have for 10 years, going from 2012. They had $1.2 billion or so in sales up through 2021, $1.3 billion in sales. So not a very large shift in sales over the entire time frame, but it's actually had some very significant shifts throughout it. As you can see, the 1.2 dropping down to a low of about 438 million or so in 2016, leading into when they actually did their IPO in 2018, and that had a pretty significant jump in their revenues after their IPO, going up to about 1.9 billion or so. And then that's come back down, moderating pretty significantly after 2020, and then back up in 2021. So yeah, the revenues have been all over the place throughout the entire time frame, ebbing and flowing with the steel prices, which we'll get into that when we're doing some of the projections for it. Another thing to keep in mind is the gross margin and how that shifted over time. You can see that prior to their IPO, they had pretty low gross margins in mostly in the teens, though there's 1 or 2 years in the single digits or negative territory, as well as one in the 25 kind of range. On average, what does that come out to? About 11 to 12% for a gross margin. And then after their IPO, we can see that the gross margin has been consistently way stronger than that, at an average of 56%. So the IPO and the capital influx that they had has significantly changed the cost structuring of their business. And so yeah, even though the revenues still seem to be ebbing and flowing pretty significantly, you can see that didn't necessarily affect the gross margins. The gross margins stayed pretty strong and consistent, which is interesting compared to, like, they even had a negative gross margin there in 2016, which is pretty interesting to see. So moving further down the line, we can also kind of see the same thing showing itself up in the operating margins. The operating margins had a pretty significant changeover in 2018, as well as also the reported net income. Let's see, we had an average net income margin prior to the IPO of actually negative territory. So lots of loss years, mostly a loss prior to the IPO. And then since the IPO, they've had an average of 37%, or yeah, 38% or so. So very, very strong margins to look at. And that comes off of the back of a pretty wide ranging of of the pricing of steel itself, like I said, we had a pretty significant dip in 2020, and the revenues had a very, very significant dip, but they still managed to pull off a consistent gross margin with what they had been having more recently. A small dip, but nothing too dramatic. In fact, they had a smaller gross margin in 2021 than they had in 2020, and then they still managed to pull off a significant income margin, overall net income margin. So yeah, very interesting company with a very strange kind of shift over in overall cost structures throughout the business, which kind of leads to a lot of uncertainty about how to project them in the future, which we'll get into kind of moving forward, as well as that because of the large amount of loss years that they have, they've actually paid a relatively low amount of taxes. So we kind of have relatively low tax rate projected for them in the future as well, but that's kind of getting ahead of it as well. Moving down to the cash flow line, we can take a look at their cash flows to equity that they've had over the entire time frame. You can see for the first 5 years, they had cash flows up to equity averaging of about 95 million, so just under 100 million or so. And then since in the last 5 years, it's been an average of 435 million. Since the IPO, it's been an average of 536 million. It's worth noting, though, that that does have this really large cash flow year in the year that they IPO in 2018, which does mean that that's the capital that came in. That the capital that came into the business was capital that's available to the shareholders. So naturally, that makes sense right there. In fact, it's so much capital that the free cash flow equity 1.7 billion. I mean, just compare that to the revenues they had in that year of 1.8, 1.9 billion. So they had free cash flow to equity not that much smaller than their overall revenues in that year, which just should tell you that obviously something different was kind of happening in that year. Not exactly normal. But you can also see that they don't really have a huge, oh, actually, never mind. I totally forgot to flip that through here. It's like, wait a minute, that's not actually accurate. I was like, they have paid out to their shareholders. I don't know why I forgot to drag the formula line down over here. Or I'm pretty sure I had done it before, but maybe I accidentally undid it when I was making some edits last night. But either way, you can see here for the first 5 years of the business before they did their IPO, though, they weren't paying out to their shareholders. It was still just an issuance of equity, which makes sense considering they hadn't IPO'd. They really wouldn't only been doing private dividends or private repurchasings under that kind of circumstance. Not very typical. And then since then, we've had an average of $410 million paid out to the shareholders per year. That 410 million, again, averaging compared to the 435. Which, yes, a large amount of that payout came in 2018 itself, but it shows that they have at least paid out their shareholders smaller amounts than they otherwise might have. Definitely not overpaying their shareholders, which is always what we like to see. They did actually have a pretty large, significant special dividend in 2018, and then have basically just kind of had a relatively small dividend since then, actually dropping it in 2020. Anyway, moving down to the returns on invested capital, we can also see that had a very significant shift once they made the IPO, which also makes sense because returns on invested capital are affected by your overall capital structure, obviously, since it's over the capital base itself. So since they shifted their capital base pretty significantly in 2018, that's going to make the returns on invested capital change. Not to mention they also had larger returns since then. So with that, they've had an average of 68 to 69% returns on invested capital since the IPO. For the last 3 years, it's averaging, showing here about 22%, but that has to do with the fact that really it's averaged much higher than that. And then whenever I have a company that has negative shareholders equity over negative shareholders equity adjusted for the cash in the business, then, which, because they do have shareholders equity right here, but it's smaller than the amount of cash they have in the business, so that's going to be that, then I actually adjust the returns on invested capital for that fact, since to me, I think of that as the returns on invested capital being arbitrarily high in a way that isn't reflective of reality, because as they start to add profits to the business, their shareholders equity will go positive after even adjusted for cash, and then that will make the returns on invested capital compress back down to a more normal level. So it's kind of a weird arbitrary adjustment that I do in here to essentially cut the returns on invested capital of the most recent year in half and call that what I think the returns on invested capital are when the net non-cash equity is negative, which it is. So this 22% is kind of an adjusted number. It's basically what I'm trying to say. But I think that's possibly more reflective of where they could go in the future. And then we'll take a look at what my actual future projections are, and then you can see whether or not you actually disagree with that. Because I mean, also just the idea that they were averaging 68, 69% returns on invested capital just because they IPO'd, I mean, some companies do earn returns on invested capital that high, but usually if they have returns on invested capital that high, they are undergoing a change in their cost structure, which is why you can see it consistently moving downward at a very, very fast clip. So really, I'm just kind of making an arbitrary judgment to try to speed up the process to get an estimation of what I think the longer term returns on invested capital are of the business. Anyway. So moving on to the balance sheet, taking a look at that, you can see that they do have a larger amount of cash on hand right now than they've had in the first 5 years of the business, but not a ridiculously large amount so that necessarily makes an argument for making returns back to shareholders, but it does show that they are at least protecting their business by accruing more cash in their business. And we can also take a look at the accounts receivable. The average accounts receivable for the first 5 years was 169, 170 million or so. Comparing that against the most recent 5 years of 221, they are increasing their accounts receivable, but not at a dramatic pace. Hey GT, what's up? Welcome to the stream. Inventories, that actually has possibly the opposite story, averaging 352 million for the first 5 years, and in the most recent 5 years, it's averaged 279 million. So their inventories have been relatively lower in the last 5 years and since the IPO, but it is currently at 301, which is not too far off from that longer term average. So you could argue that they're not necessarily that much different, but at the same time, I would say that means that they're a little bit lighter on the total amounts of their inventory in the business. Perhaps that has to do with the LTA format of their revenues. But anyway, moving downward into more of looking at the liabilities, we can see that they actually have less current debt typically on hand versus they've had in the past. However, they do have a much larger amount of long-term debt, so it's not that they have less debt in general. I guess it's just less of it is in a more immediate sense. And then comparing their payables as well, they had an average of 97 million payables for the first 5 years of the business versus 137 million on average in the most recent time frame. And comparing also just the average amount of their payables to the amount of their receivables, they do have more receivables than payables, which is always what you like to see. You don't actually want to see a ridiculously high amount of receivables because that means that their customers aren't really paying them as quick as you might like. But you do typically want to at least see higher amounts of receivables than payables. And taking a look at the shareholders' equity statement, as I kind of had already talked about, they don't have a huge amount of shareholders equity, and ever since they went IPO, they had a pretty dramatic negative shareholders equity, which is pretty common for companies that initially IPO. But you can see that it's moved towards positive territory in 2021, and then like I said, if you actually adjust for cash, well, it's not actually in positive territory, which is part of how I like to think about returns on capital, since I don't think of cash as employed capital. But either way, you can also see that the retained earnings itself has dramatically improved as well, going from negative 1.9 billion or so, now down to less than $1 billion in retained earnings, probably only a year or two, maybe 3, until they would have positive retained earnings and probably dramatically positive shareholders equity. So we can move on past the historic information, kind of to take a look a little bit more at the ratio pricings. As far as their PE ratio that they've traded at over this time frame, since they've had a relatively short time frame to look at, it's not really a huge amount to look at, but about an average of a 6 PE. You could also look at that as a positive though, because that means that we weren't looking at what their PE ratio would have been at during a lot of those more chaotic earnings years, which means they would have had negative numbers. So the fact that they weren't even publicly traded in many ways kind of is a little bit of a relief to at least coming up with a simple average for thinking about what their PE ratios were at. So an average PE of 6, but it's worth noting that's an average PE of 6 with the interest rates that existed during that time frame. That's something I always try to point out to people, is that if you're thinking about historic PE ratios, you really do have to take into account what type of interest rate was the alternative investment people could have looked at during that time frame. So if they were trading at a PE of 6 and the interest rates are 50% higher, well, then that means that they should trade at a 4. And lo and behold, they trade at a 4 sort of right now. So, that's just like a basic rule of thumb kind of way of thinking about it. But anyway, now going further down the line, we can take a look at the sales to capital ratio. Now, the sales to capital ratio has undergone a pretty significant changeover, which makes sense considering they've had a huge shift in their capital base, and this has to do with the capital base. You can see it went from an average of 0.54, 0.55 as the sales to capital ratio, and then after IPO, it is now average 0.52 or so, 0.42 in the most recent 3 years as an average.
which puts them a little bit more in line with the industrial expectation that we had. Was the industrial expectation that we had was 1.77. So seeing them at 1.42, 1.32, they're lower than the industrial expectation in that range. But the net margin that we came up with for the industrial expectation was 9%, a little bit higher than 9%. So the fact that we are seeing their margins be an average of 35% in the most recent 4 years is pretty insane. So there is that factor to take into account. So with that, that's kind of the completion of the historic information. We'll start to take a look at my projections for the future, and we'll start by thinking about the commodity pricing, as I typically do with a company that's so closely tied to commodities themselves. As I said, steel itself is not really a commodity, a base commodity. It's more of like a specialized non-commodity product made from commodities, that being iron and carbon. So I do have my separate spreadsheet up for steel pricing and trying to think about future projections of pricing. And I have the prices of steel going back to 2008, 2009 or so, which is not as long as I would typically like. I would typically like to maybe get at least 30 years worth of information, much longer if I can, for commodity pricing, but this is what I had available, and it gives me this. And now one thing you may notice relative to some of the other commodities that we have done some pricing measures for on the channel is that this one doesn't have a consistent trend upward, and that has to do partially with the fact that it's not a base commodity, as I was talking about. There's other prices that are relevant to this, which and other prices that has to do with other production values, and that means that the prices of steel is much more dependent on the global economy and the growth therein in real productive terms, relative to then just the growth of the monetary economy, like other base commodities, whereas you can see like gold, iron, even food commodities over a long enough time frame, oil over a long enough time frame, energy commodities over a long enough time frame. All these things actually move up consistently with the money supply over a long enough time frame. Something like this isn't necessarily going to do that because it's actually dependent more on real growth than just nominal growth. With that gets into the typical method that I use for trying to make predictions about the future of commodities. Is I usually project them against the money supply, and you can see that the money supply is actually negatively correlated with the price of steel, which I think is actually perhaps indicative of the damage that growth in the money supply in an arbitrary, inefficient sense actually leads to a negative effect on the potential for real productive growth in the real economy on a global scale over time. But whatever, that I digress. That's getting neither here nor there. Either way, I come up with predictions for the price of steel based off of the growth in money supply of anywhere from 900 to 1100, 1200 or so as a projected spot price in the 5-year forward period, on an average about 1,000 or so. And then moving back over to the GrafTech spreadsheet and into the technicals page, I also have the historic prices of steel at year's end placed against this grouping here, and I place them in 2 quartiles, which unfortunately, like I said, we have a very small amount of years to work with, so I kind of have to be a little bit arbitrary and shaky with how I group them into quartiles. But either way, I end up with quartile prices ranging from anywhere from 852 to 1700 for the historic prices. So you can see that the historic prices actually give a wider and higher range for prices of steel than does my projections of future prices based off the commodity metals. But either way, I'm going to use the mixture of both of those prices and kind of the range between them to give a range of potential steel prices for the 5-year forward period, ranging anywhere from 852 to 1700 and anywhere in between. I also have this little mini graph right here, which I threw up because I kind of just wanted to take a look at it, which shows the year-end steel price next to the year-end price of or the year-end revenues of EAF. So you can see how the revenues are kind of somewhat tied to steel price. The blue is the steel price, and the red is the revenues of EAF. And this is when they IPO'd. So you can see there's a huge jump in the revenues when they IPO'd, and that if it was kind of brought down to this line would actually make the curve seem a little bit better. The overall correlation between the revenues and the price of steel is actually about 30%, which is not very strong. We would typically like to see a little bit stronger than that, but in statistical terms for something like this, it's actually not necessarily as terrible as it sounds. So it's much better than the previous correlation I had with, like I said, using oil, the input price. That was closer to a 20% correlation. So this is still an improvement upon that metric itself. So with that, like I said, we end up with those commodity prices, and that gets us output revenues ranging of anywhere from 935 million for the revenues in the worst case scenario to possibly 1.4 billion or so in the best case scenario. And so that's going to be our revenues that we have input into the valuation, which comes into it right here. 935 in the worst case scenario, 1.4 in the best case scenario, leaning towards 1.3 in on the analyst measure, which has to do with the average steel price over the last year. So with that, that gets me an expected revenue of 1.1, 1.2 billion or so in the 5-year forward period, which is 12% lower than the current revenues at a compounded negative growth of negative 2.5% per year of revenues each year or so. We also essentially have an expected revenue for the year forward of 1.3 billion or so, which if we come back over to the PowerPoint presentation, which goes into the projections that they had for the year. As we had said, they have about 910 projected for the LTA revenue that they have listed here, as well as they had approximately 300 million in other revenues in 2021. So 300 million plus the 910, that's about 1.25 billion or so. So my estimation of 1.3 is maybe a little bit higher than that. So again, that maybe argues that the non-LTA revenues would go a little bit higher to make up for that. And that's essentially kind of baked into my valuation as well. So with that, we can move further down the line to our projections for margins, which is where things get a little bit shakier and a little bit more uncertain as far as like what we think that they can do over time. I have it listed here as the 9-year rolling average, which comes out to be about 12%, which is way lower than, as we were saying, the margin that they've achieved for the last 5 years, which has been 37%. So it's probably not necessarily super. That's probably a pretty significant dip to assume, but as I had kind of pointed out, you can see that the margins are coming down over time. I do think it's more likely to assume that they would be cut reasonably low over the 5-year period. Not to mention, as we had said, the industrial expectations for them is about 9.5. So maybe even if we assume that they were close to double that, which is essentially what I do kind of end up with, to make up for the fact that they have a lower sales capital ratio, they end up with higher margins, which is kind of pretty typical of what we like to do in our evaluation. So I think that's a pretty good measurement. So anyway, with that, that means I'm projecting a range of anywhere from 1% to 35%, which is a pretty wide range to put in place as far as revenue assumptions. But like I said, there's just so much uncertainty here in my mind about how to place this. But with that, that gets me a midpoint of 18, a leaning towards 20%. That gets me an expected margin of 19 to 20%, which is about double of the industrial expectation. It's a little bit higher than that actually, but we do have it drifting down to the 12% in the immediate future because of our base year effect. So we're having it drop to 13% and then drift back upward towards 19, 20%. And the reason why we're doing that is that we're assuming that that's going to be the effect of any recessionary concerns in the short term. I think that it'll crush their margins, although I do admit that I think they would be more likely to crush their revenues than their margins given their historic history. But my model is limited in the ways that it can put these things into the projection. So I think I'm going to do that instead by showing it affecting the margins instead, and then having the margins drift back upward towards this longer term average that I think is potentially achievable. And you could argue that maybe be a little bit lower than that. Maybe 30% is the wider range that brings the expected margin to 17 to 18%, which is a little bit lower. And you can see how that shifts the value pretty significantly. The 1% is a pretty low point as far as the worst case scenario goes, but the terminal value still ends up in positive territory, so I can still get away with actually doing that. And then 35% is higher than the most recent margin, but again, it's still a very, very high margin to assume that they would achieve over the long run. So I don't know, you could argue that I'm being too optimistic, and you also argue that I'm being too pessimistic on the margins, depending on your opinion, whether or not you're looking at the long-term industry that they're in, or whether or not you're looking at their historic information. Either way, you can argue either direction. So I'm kind of just giving it a wide berth. So with that, we can move down to the sales and capital assumptions, which is one of the other key assumptions that I have in place here. With that, I am kind of assuming very similar in line with the other assumptions I've already made, assuming kind of a worst case scenario that their sales capital ratio drops back down to where they used to be in the previous capital base they had, versus that it has a pretty significant spike up due to prices and that. And that's one area that maybe actually this is perhaps a little bit too high, because this midpoint was a little bit higher than I'd like to be, because the expected ratio here is actually a little bit lower than the individual case numbers having to do with the other factors of the valuation, because this is downstream from the other factors. So I don't know, maybe let me make maybe some small adjustments here, perhaps a little bit. which means I'll actually have to make a small adjustments to the default risk as well, but that's okay. And there is a pretty significant amount of default risk, as you can kind of see here, but that is definitely is par for the course, especially with the fact that we have the 1% as the worst case scenario potential margin for them. So hold on just 1 second while I try to readjust these real quick. It's the same one, isn't it? 1.18. Okay, so those are accurate. So not really a huge adjustment to be had there, but kind of want to make sure it was still at least in full accuracy. So with that, that's basically all of the assumptions to put in place for the valuation. They're that's not really value. That's just kind of thinking about its current place. Oh, I didn't adjust this one. Let's see, that's 0.5. Oops, I did that on the other spreadsheet. So let's see, anything else that I was forgetting? Oh yeah, so I did want to talk about the returns on invested capital now that we get through the rest of the projections. So again, the arbitrary move that I do by cutting the current return on invested capital in half to adjust for the fact that there has to be a growth in the equity capital base. Now let's take a look at the projected returns on invested capital. I end up with the assumption they put in place. I end up with a 25 to 26% return on invested capital with those margin assumptions, with those sales capital assumptions, and with those revenue assumptions. So you may think that, it's a totally arbitrary move. I'm just taking the most recent year and cutting it in half since I can't really trust the number to be accurate. And I know that the capital base has to grow, which means the returns on invested capital have to shrink. So cutting it in half is the arbitrary part, but I know it has to shrink. But look at that. Look at that. It ends up 25, 26, which means that I'm essentially assuming that their returns on invested capital climb a little bit over time, which is not an unreasonable thing to assume, especially if I'm assuming that their margins over the short term are going to get compressed back down. So, if this had been dramatically different in either direction, then that would have been proof that arbitrary thing is silly. But even though it's arbitrary, it at least seems to get me closer to the truth than looking at the 37, 38% or whatever, or 68, 69%. The 37, 38% was the margin. 68, 69%. If I had used that as my baseline instead, if I had just said, oh, what was the 3-year average? Oh, it was 60%. What was the 5-year average? Oh, it was 56%. And then I look at the 25, 26%. That is much more disconnected with the reality of the situation. So sometimes making a little bit an arbitrary rule of thumb sometimes can get you closer to reality than relying on the accounting figures as is, because accounting figures are subject to strange things like going public and having large shifts in your capital base, distorting the most recent numbers. So that's all of the assumptions for the valuation. We can come over to the final page to kind of take a look at everything. That basically completes the valuation. If you have watched up to this point, either live or on the replay, please give us a like. If you are not already subscribed, please subscribe to the channel. You will get notifications when I go live. I go live once to twice a week. I'm trying to keep it closer to twice a week. And sometimes I put out other videos on other content, including my most recent video on the Q2 market and overall capital markets, and my own portfolio returns are contained within that video. So please check that out. Subscribe to the channel. Give us a like, all that. So with that, ticker EAF, GrafTech International. U.S. Treasury selling most recently for 2.95, 2.96% or so. Still having difficulty giving it up over the 3% line, even though we had that inflation report coming out, which means we're probably going to have some increases in the discount rate, the Fed funds rate. I digress. Current equity risk premium I have for mature markets is 5.79%. And then adjusting for company-specific idiosyncratic risks, I end up with a discount rate for EAF of 15.35%. Pretty hefty discount rate. Their current dividend yield is 0.63%, so a pretty small token dividend for the time being. 5 years ago, they had sales of $438 million, which is the sales that they had just before their IPO, or at the kind of their low point. Like I had said, the 5 years growth of their sales is not very representative of their long-term growth because they've had a very chaotic set of sales. But anyway, the most recent sales have been $1.3 billion or so, which comes to sales growth of 25% each year for the last 5 years. Again, not very representative of their actual growth because they're not really growing per se in terms of sales. It's just more of a shift in the commodity pricing. But whatever. Sales to capital ratio prior to IPO went from 0.48 up to, in the most recent 3 years on average, of 1.33 or so, against, again, the industrial expectations of 1.77. So they do have a relatively low sales capital ratio compared to their industry. Returns on invested capital were in negative territory 5 years ago, and then they've improved to, again, this kind of arbitrary adjusted number that I have of about 22%, which, as we saw on the future projections, ended up being a pretty reasonable arbitrary move to make, because, again, it gets us pretty close to representing the most recent reality. Debt to equity ratio currently is about 69% or so, and the default risk that we had in the most recent year was about 0.85%, less than 1% or so, which is negligible essentially. Profit margins in the most recent, well, my bad, not recent, this is the 9-year rolling average, has been about 12%. Again, I kind of use that as my baseline, partially to exhibit lower margins that I expect that they might have if we go into recession, but also to represent the fact that they've had a shift over their capital base and their cost structure since they IPO'd. Before they IPO'd, they had margins of single digits, teens, negative territory pretty often, more than not. And then since IPOing, they've had very strong margins in the high 30% range on average. So using this 12% as an average kind of gives us an idea of what they've done over the longer term, and then I'm drifting towards my projected margin from there. A long digression. Again, that is higher than the industrial expectation they have of 9.32%, and then we used our expectation that they would remain higher than the industrial expectations, in fact, significantly higher than industrial expectations in our projections moving forward. Profit in the most recent year was $389 million against their current share price of $6.30. So the probability distribution that we use is an even flat distribution, which is what we typically use whenever we're using a commodity pricing model for our revenue projections. And we're using steel as our sales driver of our commodity pricing. Correlating the price of the revenues against the price of steel gets us steel prices projection of anywhere from 852 to 1763. On expected value, we see about 1200, 1300 or so in the 5-year forward period price of steel. And with that, we end up with sales projections of anywhere from 935 million to possibly 1.4 billion. On expected basis, we see 1.1 to 1.2 billion in sales in the 5-year forward period, which equates to a negative 2.64% sales growth each year for the next 5 years. And we have sales capital ratio expectation of 1.3 or so, which is a little bit lower than the current sales capital ratio, but not too far off from it. And returns on invested capital, we see climbing to possibly about 25 to 26%, which is one of the reasons we feel it's fine to do the adjustment that we did, because it's pretty close in line with our future projections. And then the debt to equity ratio, we see climbing on expected basis to possibly about 85%. On an expected basis, default risk, however, is pretty significant, about 2.6% per year on a compounded basis, which is not just in the worst case scenario. The worst case scenario is pretty high, but even up through the median model, we have pretty significant default risks, greater than 1%. Greater than 1% across the board, in fact. So a pretty significant amount of default risk is where a lot of the value goes, unfortunately. Profit margin, we have a pretty wide distribution based off of our uncertainty about where the long-term margins can end up, having to do, like I said, with that shift in their cost structure since they IPO'd, which is why I made that large digression about the profit margins and the shift between it, because again, I said perhaps twice as much as their industrial expectation is what I could perhaps see them achieving over the long run, which is about what we have on expected basis here, 19.76%. After adjusting for the wide range between 1 and 35%. And with that, that gets us profit assumptions of anywhere from $9 million in the worst case scenario to possibly $499 million in the best case scenario. On an expected basis, we see about $235 million in the 5-year forward period for profit. And adjusting for the discount rate that we have applied to the company, that gets us to a present value price of $6.70, which is 6 to 6.5% higher than the current share price. 5-year forward value targets, unadjusted for the dividends that they will pay out during the time frame, gets us a worst case scenario of $1.98 per share to a best case scenario of $34.28 per share. On an expected basis, we see $13.71 per share compared to the current share price. That gets us an implied return each year for the next 5 years of about 16.91%. which on the face of it is a pretty respectable notional return. However, it is not that much higher than their current discount rate. which I do think is pretty representative of their actual risks. It's not like I've made some caveats about discount rates on a few of my valuations before, pointing out that like for some companies, the method I use for coming up with the beta is less relevant than others, and so you can maybe argue that I'm just over discounting them. This one I think is pretty representative because of, like, for example, the debt and the default risk associated with that. That's part of the beta calculation that ends up with the discount rate that I end up with. So that's represented here. And so I think that that's actually a pretty real number to pay attention to, which means that this fair value of 670, I think, is pretty real. It's not just focusing on the forward value. So with that, even though it is pretty respectable returns, I will probably be passing this one for now and kind of waiting to see if maybe it goes lower in the market downturn and see if we can't collect it at a lower discount where it makes some of these other present values in the worst case scenarios more realized. The value score we do come up with is 0.7, which is not terrible, but yeah, not great either. So that kind of is more indicative of, yeah, I'm less likely to buy it because I typically don't buy into a stock unless it has a much higher value score than that. And as I've mentioned with several of my evaluations, the short-term pricing metric is caveated on a lot of little details, so we can mostly just kind of ignore that. I will kind of briefly compare to my previous valuation. I do have up here on my other screen. We can kind of talk about the projections I had in this one versus the other one. As I had said, because I didn't have access to daily steel prices at the time when I did the previous valuation, I actually did it based off of more of their cost structure inputs, which was the petroleum coming from oil needed for their petroleum needle coke. And so I actually had sales driver of oil on expected price of $78 per barrel as my input driving, and that gave me $1.2 billion as the expected revenues in the 5-year forward period. And again, that would have been 1 year earlier than the 5-year forward period in this valuation because it was a valuation done a year ago. So by switching to the steels driver of about $1,200 for steel, that gets me a sales expectation of about 1.2 billion, which is a little bit lower than the actual 1.2 billion over here. It's 1.188, so roughly the same or so. But again, this is 1 year forward, so I've actually lowered my revenue assumptions for GrafTech in this valuation compared to the previous valuation. And then in the sales capital ratio, I have 1.3 versus 1.27 on the other one, so I've actually improved the sales capital ratio here. The returns invested capital on the other one are 22-23%, so I've actually improved them 25-26% here. The debt to equity ratio is 91-92% there, versus here I have it at 85%. But granted, and the current debt to equity ratio was 90% there, while it is 69-70% here. So they've lowered their debt since then, and I'm projecting that the market cap could adjust for that fact. Whereas they, that one, I assumed that their debt to equity ratio would stay flat with where it currently was. The default risk, I've actually lowered it in this valuation compared to the previous one. I had an expected value of over 3% on that one, so it's now down to 2.6. So it's an improvement there a little bit. And then the profit margin, the range is actually the same, 1 to 35%, leaning towards 20%. However, because of the expectations calculations that I've changed over since then, it's actually giving an expected profit margin lower in the previous valuation than this one. So that's a little bit of an improvement on this one here. And with that, I also have lowered the discount rate. The discount rate went down from 16.5 in the other one to this one, 15.38, which is interesting because a lot of my valuations, the discount rate has in fact gone up. So it's interesting that with all of those things in account, we end up with the valuation that we do here, which is that my current valuation is $6.70 versus the previous valuation, it was actually $7.20. So I've actually lowered my valuation, and the value score went from 0.87 to 0.7, partially because of the change in the range of the valuations. So I feel much more confident with this current valuation of GrafTech, but unfortunately, like I said, that does mean I did lower the valuation a little bit. Not that the valuation was necessarily the most amazing of buys previously. Like I said, it was a much better valuation relative to its discount rate. Still a little bit better margin of safety, but not a huge one, and not enough to necessarily take a bite at that pricing. But the current one, even less so. So that is just what it is. So yeah, that's gonna be it for GrafTech. Very interesting company. Very kind of interesting little industry to be in that I like to pay attention to, and I definitely enjoy having it in the watch list. I'm definitely happy that I updated it, but we're definitely not going to be taking a bite out of it for now. So with that, it looks like back over here, my watch list, I just refreshed it. And it looks like Google decided to actually play ball a little bit, which is nice. We'll maybe take a little brief look at the watch list before we go. Not necessarily too much to talk about in that per se. I know with our previous valuation, we were looking at the other stuff. Inter4, I'm still very much interested in taking a look at maybe starting a position in Inter4 based off of the great valuation we saw. Based off that, if you missed that stream, go ahead and check that one out. But I haven't taken a snag at that one yet. Maybe I will starting next week. I typically only buy once a week, so sometimes I will do it another time a week if it's a starter position. But like I said, I'm going to be slow with Inter4 because I think lumber prices could come down in the short run. But perhaps that's just going to be it for today. As I said earlier in the start of the stream, I've basically finished preparing my stream for Kroger, so that's probably going to be the next one. And then I'm also looking to do Virtue Financial, VIRT, probably as the one after that. Looking for potential suggestions for the one to do after that, because I kind of have an open slot after that one before some of the other kind of scheduled valuations start to come in. So to kind of show for myself again, if you have watched up to this point, please subscribe to the channel. Please like the content if you want to see more of it. We stream once to twice a week, trying to do it basically around the same time, 12 p.m. Western on Tuesdays and Thursdays, my current days off. Trying to produce other videos as well on the side. But if you could subscribe to the channel, that helps attract more people to it. And if you could like the content, that helps get more viewers, which who can eventually perhaps be future subscribers. And if you haven't already, please join the Discord. The link is in the description below. We like to have lots of discussions about companies and analysis, as well as our own portfolios, chatting about all sorts of other things and dropping various market related news and research about things like that. Not to mention, you could pester me to get into voice chat, depending on how available I am from time to time. But there is voice chat, so sometimes we like to have discussions about things. So joining the Discord is another option for viewers who want to get involved. All right, I'll catch you all again next time.